A huge rally today after FOMC. You could see here we did retest this 2020 bottom line. I've talked about this one before. This is the one that started at the 2020 bottom after the major crash that we had. If you go here on the daily chart, you can see here this starts at the bottom of the pivot here. Also, you can connect it to the June 17th low, and we actually bounced right off of it today after FOMC began. So you can see that it did act as a key support. And as you guys know, that I am a bear, especially for the macro term. We've seen a lot of upside in the short term so far, but this is mostly fueled by shorts getting squeezed out. So it can make it difficult, certainly, to be short when you have these types of conditions where everything seems to be rallying. It seems like it's back in 2020, 2021 again. However, I still believe this will not be the case. Like I said, it is difficult, especially when you see this much upside in the near term, to want to hold short, especially because, again, everything seems bullish. But I do believe that we will end up seeing the bear side eventually throughout this year. So I remain with that thesis. And another interesting line here to show you, we actually closed right on that line. You could see here at 4,119 today. This line started in the 2018 high. You could see the gray line right here as I drag back, and this started at the 2018 high, connects to the pivot from the 2020 high we made before the big crash. So there's two key pivots here. One is the bottom of the crash we had in 2020, which I just showed you that line, and then the other one here, this is a key pivot as the top of the 2020 before we had the big crash, and this one also drags back to 2018. You can see here we actually closed right on this level today. And what's interesting about this structure, I want you to pay attention to kind of what we have right here on SPX. We have a double top over here, and then we closed right above where this double top was before, just right below this line over here. Now I want you to look at the .com crash. You can see here between 2000 and 2002, you could see there's a very key similarity in the structure, at least at the moment, of both the .com crash and also the correction we are experiencing right now, the bear market that we're in. You can see here we have a key downward trend line just like we have right now. This key downward trend line that started back at the all-time high, or previously, or close to that all-time high in August of 2000. You can drag it across. You can see that it was respected on the way down. It touched up here, fell off, touched and went just slightly above, and then fell off of that to make another low. Kind of similar to what we saw last year. We saw the original March rally and then fall off, and then after that we saw the August rally up to the downward trend line, and then we saw it fall off to make a new low for the year. Again, very similar. This is referred to as fractal analysis. When you look at similarities in the past and try to attribute them to the future, it doesn't mean that it has to be the same exact price action, but it can give us clues to how things may interact, at least price, in the future. And what's interesting here is after we had that low form, there's a big rally that occurred afterwards where it ended up forming a double top right here. Remember the double top I just showed you that we experienced in December of 2022. This also happened to be December of 2001 that we saw the double top, and then we saw a drawdown for consolidation at a lower price. Very similar to how we saw price action through the past couple weeks so far. Before this rally we're experiencing right now, we saw a lot of consolidation, and then a rally began again to form a double top, which is interesting because right now we're right around that double top formation. We did just break above, which is a key thing, especially if it's able to hold on the weekly candle for this week. However, we are right around that double top formation, or at least the double top that formed in December, right around that price for that formation. And look what happened after we retested up around that level. It started a very, very large drawdown. Again, does this have to happen, or to this degree, does it have to happen at all? No, not by any means. However, it's something to note because in the past, this is what we saw happen. We've seen a lot of similarities throughout this bear market. Like I just said, the big run up for March for 2022, and then a big drawdown, and then we saw the run up again till August, and then a big drawdown to make new lows. And then yet again over here, we're seeing similar structure in price action that led to another big drawdown afterwards that took out the lows of at least back here from 2001. And that would mean if history repeated itself, the lows of 2022 would be in jeopardy as well. So this is something to note, something to watch. Again, the weekly close for this week is key. It should close below the double top that formed from this past structure. Again, December of 2022, very similar to December of 2021 right here. But again, just looking back at the current chart structure, we have that double top, we have the consolidation here, here, big rally upward again to retest the price range of that double top that occurred. Also is above the downward trend line, which was the same thing that happened in the .com crash, which a lot of people probably thought back then that we were breaking out and going to all-time highs or much higher prices because of that key trend line breakout. However, the macro conditions were a lot worse, and just because it broke out, technically speaking, that did not keep things propped up for very long, and it fell off after. So again, that's just one data point. You don't want to make a thesis just based on one data point. We always look at a lot of different variables. However, it's a very key one, and again, has had a lot of similarities to this bear market so far. So definitely you want to check and at least monitor that fractal that we saw from the .com crash. And speaking of using multiple variables to form a trading thesis, I do want to talk about dark pools here, because this is a variable that I use and has had a lot of consistency, at least consistency of outcome. Whenever we see a big rally like this, again, similar to August, similar to March, even right before the bear market started in January of 2022, we saw a lot of dark pool distribution before the big downturn started each of those times. So something that I've been monitoring the past couple weeks especially is the dark pool levels feature here on Cheddar Floats, the fourth one down. This is something that I've been watching closely because I want to see large premium blocks hitting the tape, especially as we continue higher, because in a rally like the one we're in right now, as you can see for just SPY, it is super unlikely that big money, at least institutions that have access to these dark pools, are buying a lot of blocks of shares up here as we continue going higher and higher. They at least would want to wait for a dip. We saw a decent amount of accumulation from back here during this consolidation period. So as we go up, if you see these large prints, or at least large blocks of them each day, that can be a telltale sign of a potential, at the very least, pullback approaching. So this is something that I'm watching. We haven't seen an insane amount, but it also isn't that light. We saw 1.5 billion today in dark pool premium for signature dark pool prints. Again, nothing too insane. If it was under 1 billion, that would be barely anything. If it was over 3 billion, then that would certainly be more noteworthy, but it's smack in the middle of that, so nothing too interesting. And if you go back to each day like Tuesday, you can see here we had 2.1 billion again, right in the middle of that, like not being too interesting at all. And that's been a consistent trend throughout the entire past week and 2 weeks or so. Again, 1.4 billion here to start off on Monday. But this is something that I want you guys to check each day as well as we continue forward, because when we start to see, and it will happen at some point, when we start to see a lot of premium hitting the tape for the dark pools, whether it be a singular dark pool print or a signature dark pool print, that is a sign of potential risk for the market. So do be watching for that, because it's something that has had a lot of consistency in the past. Every single time you can look back and see, every single time a major top is formed, like August, end of March here, and then again right before the bear market started, we've seen a lot of distribution in the dark pools. So I suspect it will be very similar once there is a top that forms around this range. Additionally, I mentioned the VIX in the past couple videos so far, and nothing's really changed here. We're still within this box here, which again, every time the box has been touched, it has prompted a pretty substantial bounce, at least to over around the 34, 35 range, as we've seen in the past over here. So right now, if history were to repeat itself, it would end up bouncing around this range. It has taken a while down here, especially in comparison to other times. However, in the past, like you could see here, we saw a lot of consolidation before a bounce up. So as of now, it's been a lot of consolidation as well. And we're going to see it probably very soon if it wants to have some follow through and some form of a bounce, because these are levels that have not been seen since before the bear market started. So risk in terms of just volatility has seemed to be taken off the table completely as of lately, which I would argue we're still in a pretty bad situation just in terms of the macro picture. Again, the Fed is still tightening. Yes, we saw them drop to 25 basis points this time, not as substantial as the previous time, as we've seen from like the past year and stuff. But again, they're still tightening. That still has a lagging effect on the economy. It's not something that you see immediately. So in terms of just earnings, you would expect earnings to have a lag effect as well in the market. We're right around this earnings season / next earnings season, you see some difficulties across the board, because remember that when the Fed tightens, that is a lagging effect. Yes, the market does like to price in the future. However, we're still amidst them tightening. We're still seeing the balance sheet runoff at the moment. So I would not think that we're completely back to pre-bear market levels that we saw before, just in terms of overall risk. Yet that is what the VIX is showing right now. So that's a pretty big discrepancy from at least what I'm seeing just macroeconomically compared to what the VIX is looking at right here. So again, just be mindful, we're in this box yet again, and every time in the past that it's hit this box, it has prompted a big bounce off of it. So continue to monitor the VIX. So overall, I still stand by my bearish macro picture. Yes, again, the immediate term has been very bullish to the upside. We've seen a big squeeze so far, especially from these levels back around like the mid 380s, this big accumulation phase we saw during consolidation. We've seen a lot of upside so far. However, again, with time, I do believe that this thesis will play out, and we will know if I'm right in a few months at the very latest. So certainly some interesting times that we're in right now, and I will see you guys in the next video on Sunday.